Well, the 2022 IRA account limits have been announced. And oh, by the way, that's not redundant. Stands for Individual Retirement Arrangement Accounts. Well, they have increased a bit. First of all, you can contribute up to $6,000, or if you're over 50, $7,000, sometimes called the catch-up rule, and that's been effective now for about 3-4 years. Those contribution limits apply to both the traditional tax-deductible taxable IRA account as well as to the non-taxable Roth account, being the total of the two added together. And as we will see, maybe a little bit of both is not such a bad idea, but we're getting ahead of ourselves. For the traditional tax-deductible IRA, you may contribute regardless if you do not have a pension plan. If you do have a pension plan, which is indicated on your W-2 form in box 13, then you're subject to the following limits. If you're single or filing separate, it's now been raised $3,000, and the range for the cutoff is between $68,000 and $78,000, with a sliding scale between those two numbers, cutoff at the upper end, fully deductible at the lower end. If you're married for the traditional tax-deductible IRA, the limits are $109,000 all the way up to $129,000, and again with a sliding scale, and these are up $5,000 from 2021. For a tax-free Roth account, that's both going in and taking it out, for a single person or filing separately, the limits are $129,000 up to $144,000, and again on a sliding scale, and these are up $5,000 from 2021. If married, the limits are $204,000 up to $214,000, sliding scale in between, and these are up $8,000 from last year. The Roth account is available for those regardless of whether you do or do not have a qualified pension plan at work. As has been mentioned elsewhere, but certainly bears repeating, if you start earlier, it's not only better, it's far better. If you start at the age of 20 versus 30, going to the age of 60, or let's say 30 versus 40, going to the age of 70, looking at 30 versus 40 years, guess what? That extra 10 years, only a quarter of time, will double the amount you have at the end. And if you put it into no-load, low-expense ratio funds, let's say saving you maybe 2% a year, that will double it again. And you know, this doesn't apply to those IRA accounts. It also applies to your pension plan at work. So start early. It's really a good place to put your first spare monies after paying off that credit card. Well, the question always arises, which is better, the tax-free Roth or the taxable traditional? Turns out it depends, notwithstanding the self-appointed market gurus. Here are the states that have no taxes. So if you're going to have a low tax rate at the end, either because of your income or you move to a state with low taxes, you're actually better off with a fully taxable IRA account, the traditional one. On the other hand, here are the states that have a high tax, or if you're in a high bracket, then you're better off with a Roth. There are some other housekeeping rules to take note of. The requirement at the age of 70 and a half has been moved up to the age of 72 for you to make required minimum distributions, and that's from both your traditional tax-deductible and likewise your pension plan at work if you're no longer working. The Roth has no such requirement. Well, as always, keeping you up to date with DrCinvests.